I'm Chris Preston.
I'm Brad Simmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network. I know it was one person last week, Brad. Thank you for um, going solo-ish while I was out on vacation. I listened to some of your conversation with Nancy about housing. Madison, our producer, sorry that you're still looking for a house. It's not a great, not a great time for that, but um, but good stuff there, and thanks for filling in. Lots to talk about today because we have a lot of things to catch up on. So I've been gone the last couple of weeks. Brad, tell people what we're going to talk about today.
We definitely have to touch on inflation. We had both CPI and PPI reported that showed a little bit more inflation than I think people would have been happy with. We'll talk about what the Fed's options are for dealing with that and what we can garner from some upcoming dates from them. We will talk about market being at all-time highs, but there are some signs of stress under the surface. Cannabis stocks rallying, and then we're going to spend a little bit of time talking about Duolingo.
But first, as always, is defend the take. And this week you're up, Brad, and your take, for which you have 90 seconds to defend yourself, is Warren Buffett confirmed that United Health, UNH, is a good buy. But there's a better way to play it. 90 seconds, go.
So, we will talk more about valuations and how elevated they seem to be for the entire market. UNH, not the case for them. They have been absolutely hammered for like the last year plus, value chopped in half. Um, they they have been showing significant signs of bottoming. Most notably, the on balance volume diverged between the April lows and recent lows, which showed that selling pressure is being sort of exhausted. Um, Company also pays a dividend. The general economic environment is favorable for large companies right now. UNH is probably not super likely to be damaged by Department of Justice enforcement, given the political backdrop. So, like, there's this confluence of events that makes UNH a decent looking buy. Full disclosure, I've been sitting on this one for like a week, and Buffett sort of spoiled my party by disclosing that he had taken a big stake. I think UNH is up something in the neighborhood of about 10% right now. But the thing I want to point out for investors that are trading the rebound is there might be a better way to play it. That's UNHG. It's a 2x long UNH ETF. It's only been trading for like a month. Obviously, with it, you lose the dividend because it's just trading a synthetic double long position. So there's no pass through there. But as far as trading a rebound in UNH, that seems like a better way to do it. There's a lot of room for recovery for it. It broke out, UNH did, on the Buffett news. I would be probably maybe taking a partial position here,
Right.
giving it some room to cool off. And then as long as UNH stays technically strong, UNHG looks like a better play.
Okay. Yeah, I looked up UNH is all it's up to almost plus 13% for the day. So it continues to rise. Um, yeah, so I had I think UNH was a recommendation in my stock of the week um, newsletter end of last year, I think, end of 2024. And then the shooting happened and Trump's threats towards, all the big pharma companies really took big pharma stocks, healthcare stocks down a lot, and UNH more than any of them.
Yep.
I couldn't hold on to it anymore. But I had been thinking like, yeah, I bet it's really undervalued now. I mean, the demand for healthcare doesn't go away. As our Tom Hutchinson often says that, aging of the population is sort of a global, you know, trend. I mean, it's a bigger word than trend, but thing that is going to drive healthcare revenues and by proxy, you would think healthcare stocks in the coming years. And this is one of the biggest ones. And right after getting knocked back, seemed like ripe for Warren Buffett and for value investors. So yeah, I like that take.
Like the issue that would maybe be an overhang would be if there were lower like Medicare reimbursements. So if there was something sort of top down politically that harmed them, that would be like the fundamental concern I would have. Honestly, I was sitting on it waiting for it to close a recent gap down and then hopefully poke above its 50-day line and start heading higher. And instead it sort of blew through both of my technical thresholds. So jumping in right now, I would feel a little bit late to the party on it. I certainly think there's room for it to retrace, especially if we get like a short-term sell-off. I know that's something that we have talked about that I think a lot of investors are sort of looking for. So maybe a little bit overheated, but I think even in the next 6 to 12 months, just finding a good entry point for it, something where you're comfortable with it, and then trading the leveraged ETF off of like UNH's technicals. So if you see that break back below the 50-day, you bail on it.
Yeah, and for perspective, it's still down 40% year to date, 47% in the last year. Peaked around 615 last November. No, yeah, I guess sort of a double peak in November, and then well, it came close in April before the bottom fell out. Yeah, the high is 615, and now it's less than half that.
I mean,
Uh,
it could you
625.
and UNH could run up 30% before it even hits like technically challenging valuations. So if it runs from 305 where it is right this second to like 400 or like 390 where it's in that 28-30% range, I think that's probably your first like technical overhead. PE ratio at 13 right now, so it's undervalued from that standpoint. I think there's more legs left in it. The volatility is coming from Buffett, and that was a big disclosure that I know investors online have been waiting for is like Buffett's secret stock is going to get disclosed, that kind of stuff.
Right.
But I think there's more. I think there's more legs in this.
All right, let's shift to our starting five. Number one, two key inflation reports this week: CPI, PPI. CPI slightly higher than expected, nothing too troubling. But PPI, Producer Price Index, came in, was it yesterday, 2 days ago? I don't know. This week, that was showing data that was a little more, maybe disturbing is too strong a word, but 0.9% increase, which is the larger than what was expected and was the biggest increase month to month since June 2022. So more than 3 years. Um, I think 0.2% was expected. Um, Prices for final demand goods increased by 0.7%, largest increase since January of this year. 1.4% rise in food prices. Basically showing is all either multi-month or multi-year highs in terms of the jump. Market pulled back a bit initially, but it did not implode. We'll get to the market more in a second. But what was your takeaway, and how much I guess is this a red or yellow flag to you?
It's like loosely a red flag to me, but it's been loosely a red flag on my radar for 6 months,
Right.
right? Like the core,
Almost a red flag that's not a red flag to the market yet, you know?
yeah. I mean, there was a fund manager survey that found like 91% of fund managers think U.S. stocks are overvalued right now. Core PPI was the highest in 3 years. It was up 0.6% month over month. Wholesale, like fruit and vegetable prices were up like 40%.
Yep.
The I think the reason that the market maybe shook it off is that even the bad news isn't a surprise. It's the bad news is coming from the places where you expect it to come from, where, okay, we have, there have been a lot of headlines about immigration crackdowns leading to fewer farm workers being available. So naturally, farm goods prices are rising. We're seeing higher prices in areas where the tariffs are hitting, right? Like the bad news is priced in, I think
Yeah.
is the big takeaway with it. The one thing that I think maybe is not fully priced in is how long this is going to take to the tariff implementation and some of these cost increases, how long it's going to take for them to flow through. We pointed out back in the day that Powell got sort of famous for saying that inflation was transitory. But transitory doesn't mean it happens one day and is gone the next. It means it takes like 18 to 24 months to work its way through the system. So I think that what we are looking at now with our pricing increases due to tariffs is something that's going to have a long tail. It'll take 6, 12, 18 months to fully be priced in. That is the thing that I think the market is not fully pricing in right now. Yes, we're
Right.
seeing higher prices. Yes, everybody's expecting it. Yes, the economy is sort of broadly holding up. So it's easy enough to look at these numbers and come away from it with the where it's a disappointment, but it's really meeting expectations. The thing that I don't think is fully priced in is how long it's going to keep meeting expectations or keep being higher. That would probably point to more weakness later in the year. When September, October rolls around and we're still getting, close to single digit inflation figures for some elements of the CPI or for some elements of the PPI. That I think is when we'll hit sort of a fatigue point. I don't know if it's going to cause people to totally re-rate stocks, but we are in the early innings of this, and you're probably well suited if you bake that into your expectations that we are going to be dealing this for quite some time.
Yeah, I mean, just to shift to our next topic, I think the market's lack of apparent concern over this was less surprising than the jobs report reaction, even though that was the one truly down day in the last, what, 2 weeks, month, really, where stocks were down. I think Nasdaq was down like 2% after the really weak July jobs report came out. Was it 2 weeks ago today, I think. I thought this was a repeat of last year, where really weak jobs numbers sort of tanked the market for like more than 3 weeks. S&P down 8+%, Nasdaq down 13, 14% in that span. I thought we were headed for something similar because numbers were so bad, especially the revisions from, was it May and June? It was like in the
Yeah.
teens, 20s, something like that. Teens, 20,000s. Um, the lack of concern there that's where I was like, okay, it seems like this market it wants to go up. Clearly, it's shaking off just about everything. Um, I, I think you could make the argument that I had said a month ago, prior to earnings season, I thought that this earnings season would act more as foe than friend, with the market sort of already overcooked coming into it, and with earnings expectations a bit more muted. Like 5-6% growth was expected after, which isn't bad, but after two straight quarters of double-digit percentage growth, and they've been much better than that, 11% plus. I think 80% plus have beaten estimates. So the economy, at least among the largest corporations in the economy, U.S. economy, are still thriving. And that, I think AI is clearly a big reason for that, and a big reason for the top heavy nature of the rally. The big tech is really driving it yet again. Um, but that has really, it's been sort of a buffer against any truly big pullback, it seems.
Yeah, there were a lot of potholes this earnings season for
Yeah.
individual
A
companies
lot of
where it's
lot
like,
of blow-ups on earnings beats, which we've seen in the past.
yeah, so I mean, it's really do we want to just go to the market and then bounce back to the Fed, or you want to hit the Fed real quick?
Um, yeah, so Fed, okay, I guess so. Does this report
Let's
make you think the Fed does this change your calculus for what you think the Fed will do? So let me pull up Fed Watch.
Yeah, let's put a pin in earnings talk because I think that goes sort of
Yeah.
hand in hand with
Yeah.
market.
Yeah.
So the Fed, at least
91% chance of them cutting rates next month.
it was 94.3 on August 13th. And that was before the PPI report. After the PPI report fell to 92.1. So now it's a little bit lower. Um, I think the Fed, in an ideal world, the Fed would still have the luxury of playing the waiting game.
Yeah.
But their hand has essentially been forced. The market is fully expecting the
Hmm.
rate cut. Typically, when expectations are this high of a consensus or this strong of a consensus, that is a good indication that the Fed is cutting. They tend to not come out like if it's a 50-50 or a 60-40, the Fed might and come out and throw you a curve. But once you get into that 90% range, that tends to line up, or at least it has all year. The thing to watch is going to be Jackson Hole on August 22nd. That is Powell and by extension the Fed's sort of highest profile and last opportunity to reset expectations.
Hmm.
If they are, we already had two people dissent the last time the last meeting, which was very public and something we haven't seen for quite some time. Um, the the Fed committee is mostly on board with cutting. Add into that the political pressures and right, I think the odds favor that the cut comes. If they want to challenge that narrative in any way, it's going to come on like the 22nd. It's going to come from statements with Jackson Hole. Economically, I think it makes more sense not to cut. We are just starting to see the early impact of tariffs. And like I said, that's going to be 6, 12, 18 months of lead time for that to fully be priced in. And the Fed does run the risk now of cutting rates into rising inflation, which is just going to continue to be more inflationary. So if I had a magic wand, I would say let's tone down the political pressure on the Fed to cut and sort of let them do their job because they have had a strong track record over the last couple of years.
Yeah.
But that's not the world we live in. I I think they bow to pressures and cut. But if they come out hard in Jackson Hole and say it's going to be inappropriate to cut without more data, then I think you moderate those expectations a little bit. The right move is not necessarily the move they'll make.
Right. And as Cliff Droke noted in his Cabot turnaround letter issued this morning, Bank of England just made its fifth rate cut in the last year. And historically, the Fed starts to cut rates when the two are sort of not necessarily in lockstep, but the two cut rates sort of in tandem with each other, at least to some degree. So that level of rate cut, could also be putting extra pressure, or making them think like, hey, maybe we we should be doing the same. We'll see. Yeah, I do think. I think we both been pointing to September, like everyone else, that it's likely to happen. I think it'll happen. I think we'll get two cuts the rest of the year. Maybe that'll be September, October. I don't know. Let's see. December is they're putting in 41% chance of three cuts by then, 45.6% chance of two cuts. So I guess, I'm saying what the majority is. 13% of are saying just one cut, and less than 1% are saying no cuts. We'll get cuts, I think. Whether that's one or three, I'd land on two, as I've been saying all along.
Yeah, I don't know where the departing Fed committee member, I don't know where she had landed as far as like voting for prior cuts or not. I don't know if she's historically dovish or hawkish, but
I can tell you what the new member will be.
yeah, the new member is going to be screaming from the rooftops that we need 100 cuts in the
Right.
next 2 weeks.
Yeah.
Um, so I mean, that certainly shifts like the balance of, I'll call it the balance of power, but the balance of preference to become more dovish and start cutting rates, even if it's potentially ahead of time.
Yeah.
Um, I I think we would need. I think probably we get the rate cut in September, and then unless it's something that we're getting like closer to 4% inflation or 3.5% inflation, like on a year over year basis. I could see them doing two cuts. If we see a big spike in inflation, maybe they only get one cut. Seems perfectly reasonable to hold at four. They've been content to hold it 4.25 to 4.5. No reason they can't make one cut, wait and see, make another cut, wait and see. But if they're caving to political pressure and market pressures at this point, stocks at all-time high, then maybe they overcut and maybe we're then stuck dealing with even higher inflation for longer. We'll
Right.
see.
Okay, let's shift back to the market and earnings. We mentioned the market, still it's down today, but still hovering near all-time highs. There have been cracks that have appeared under the surface. I think it was either Cliff or Mike. I think it was Cliff that noted that, or it might have even been Jacob Mintz, noted that the market was or the S&P was at all-time highs earlier this week or the start of this week, even though more than half of its um, component stocks were below their 50-day moving averages, which is
Yeah, yeah, that Mike has written about
that
that a little
Mike?
bit.
Yeah,
The Nasdaq 100, half its component stocks are below their 50 days.
maybe it was
Uh,
NASDAQ. Yeah,
and he also pointed out the fact that equal weight, if you look at the Nasdaq or the S&P equal weight, it's up like 12% in the last 3 years, I think. Um, there's been a pretty sharp divergence between the equal weight and the headline indexes. So Mike just published a Cabot Wealth Daily article um, Thursday, I believe is when that went out. So you can read that and you'll get a little bit more detail there. I thought he had some good takeaways.
Hmm.
But the sort of brass tacks version of it is when we get these kinds of divergences, one of two things happens. Either large caps and like the headline indexes correct down to match the rest of the market, or the rest of the market catches up and closes the gap.
yeah,
Um, and right, I mean, we saw small caps rally in the first half of this week. They've sort of given that back the
yeah,
last 2 days. So it seems like when the inflation figures, the PPI inflation figures specifically came out, that made the market a little bit gun shy about really buying into the smaller cap indices. And I wanted to highlight something from Oak Tree Capital from Howard Marks, one of their who I don't know exactly what his role is. He's a manager at Oak Tree Capital.
yep,
He pointed out that he's not worried about the Mag 7 at 33 times earnings as an aggregate price to earnings ratio. He's worried about the non-Mag 493, which are all trading at 22 times earnings, which is still really elevated above like mid-teens historical averages.
yeah,
Reason I wanted to point that out is because we were talking about earnings blowups. These other non-Mag 7 companies that are coming out and slightly missing or beating and setting low expectations and then getting hammered for like 20%. That's where we are seeing that play out in real time. So that overvaluation is directly leading to these blowups. Um, I mean, I don't know how much
yeah,
juice is left in the AI lemon. I don't know. There's probably a better way I could have said that.
yeah. I do think that AI, and you wonder if it'll have a similar fate. If AI is going to be a years long driver, already been a couple of years long catalyst or tailwind for the market in the same way that the dot-com boom was late 90s, and which, had a comeuppance at the just after the turn of the century. The bubble burst. Stocks were down more than 40% over the next couple of years. I wonder if we're headed for a similar fate. There may not be as many, at least now, not as many companies because we talked about the thin nature of the rally. It's how top heavy it is. It may not be as widespread as it was back then. I don't know. I wasn't. I was in high school, but um, I read that in the New York Times. There's an opinion column saying that, it was worried, they're worried about something like that, or, or pre-subprime mortgage. I mean, that is a little different thing, but wasn't a specific sector prior to the 08, 09 crash. I mean, I guess housing, but it was different from the dot-com boom. Um, I don't know. It could, this could blow up now, soon, or a few years down the road. I do think a blow up is coming, but I wouldn't start investing preemptively based on that premise.
Well, I mean, that's the thing is it's also really hard to avoid having exposure to companies that are in the AI space because
Right.
they are the lion's share of the market, right? Like they're a large minority of the market. Just owning an S&P fund, owning a target date fund, own it, you have to consciously take steps to avoid exposure to it at this point.
I don't know
Um,
why you'd want to now. I mean, like at least, if you avoided AI the last couple of years, you've missed out on some great
yeah.
returns. Yeah.
Yeah, or if you've tried to like finagle your portfolio so that you're not overexposed to it. Um, you know, one of the things that I've been sort of looking at, and I think this will be a good transition to talking about Duolingo is like, all right, well, where's the money coming from? We know that the big tech companies are spending a ton, but what's the return on investment? Are people continuing their spending? Who's making money? CoreWeave was a company that reported last week,
Hmm.
or earlier this week. I don't
Yeah. It was recent. I don't know which, but
just I think a couple of days ago. They're partially owned by NVIDIA. They essentially rent out AI server capacity. They're down 26% in the last 5 days.
they
They had,
reported on the 12th, so 3 days ago. Yeah.
yeah, they had like a big buy-in from OpenAI earlier this year around when they were going public, where OpenAI committed to like 11 billion worth of spending with them, which got which almost doubled their backlog. Their latest earnings report didn't really show much backlog growth. I think they went from like 28 billion to like 30, 31. There's also there is some evidence I think that the data center build out is sort of we're nearing a cap on how much interest there is to keep building out more data centers. I think
Right.
we are at a point where people have been investing in this. And when I say investing in, I don't just mean like individual investors, but big companies have been investing in this because it is sort of existential, right? If you're the first company to come up with AGI, artificial general intelligence, or ASI, artificial superintelligence, it's like being the first country to have a nuclear weapon, right? You're set for the foreseeable future.
Right.
Um, if it becomes evident at any point that that is not a viable that large language models specifically are not a viable pathway to what most people would consider to be artificial intelligence as a tool, then somebody has to be the first one to pull the plug and slow down their capex spending. For the time being, the capex spending is what's holding up everything.
Right.
Um, Duolingo. This is why I wanted to
Yeah.
transition to
Let's
this
shift to,
one.
to Duolingo. Yeah.
Duolingo closed from their close on August 6th to their open on August 7th. They were up 30%. So Duolingo is a foreign language instruction app. They also teach, I think, music and math. But intraday, they dropped 13%, partially because they were overheated after such a strong pop, but partially because it was the same day that OpenAI did their GPT-5 live demo.
Hmm.
One of the specific things that they did, that one of their developers did, is he came out he said, "All right, GPT, create an app, a web-based app to teach my girlfriend French." And OpenAI's GPT-5 just real-time coded a web application that was intended to teach the guy's girlfriend French. So Duolingo dropped 13% that day. As of the close yesterday, they were down 4%. from after reporting earnings.
Mhm.
The the profit opportunities for anybody that's not like an infrastructure play or that's not one of like the big four artificial intelligence plays are potentially a lot smaller. Like if you're not providing server capacity or if you don't actually have the model that people are directly subscribing to, it it is a big threat to software companies that are out there. Um, so the fact that we're maybe not seeing a ton of profits yet from AI tools may not be an indication that they're not coming. It may be that they're only going to be coming to the AI leaders that all have their own models. So your Metas of the world, your Open AIs, Google's, et cetera. So it may not be that there are no profits coming in the future. It may just be that the profits are going to be really siloed within the specific ecosystem, and there's just not going to be a ton of opportunity for third parties to come in and essentially wrap an AI tool with their own user interface and their own subscription service. So
Yeah.
so go ahead.
No, I was gonna say it's so they beat earnings by 32%, hence the pop was up from, let's see, 343 to 391, closed on the 7th, so a little over a week ago. And now it's at 330, so it's lower than when it started. Um yeah, I think that was just sort of an example of what we've been seeing a lot this earnings season, why there are so many stocks that are below their 50-day moving average, is even companies that beat earnings, sometimes, they'll either get an initial big pop like Duolingo did and then come crashing back down, or they just, fall even after beating earnings because, there's one sort of obscure number in there that the stock was overcooked, and investors find a reason to not get back. Duolingo was not overcooked. It peaked back in like the mid 500s back in May, but I think it is just sort of a microcosm of what's been happening this earnings season. And um, the big boys we're back to where we were in 2023, where the big boys are really leading the charge and benefiting most, and dragging the indexes to all-time highs. But beneath the surface, there are cracks forming.
Yeah, so I was thinking about this when we were talking earlier. Um, the US economy growing versus like the Eurozone, where it's been sort of stagnant. Oh, we were talking about the equal weight, right? Where it's up like
Yeah.
12%. Well, without the AI spend, there's a group, Pantheon Macroeconomics. They found that without AI spending, the US economy would have grown at less than 1%.
Hmm. Yep.
And one of the places where there is not much in the way of AI investment is Europe, sort of global ex-US and ex-China, I guess, but China is sort of its own case. Um, part of the big push for AI spending and part of the profits that people are making in the indices and in these companies is increasingly looking like it might be the only game in town
Yeah.
for generating like meaningful growth. Um, I think that makes this a challenging market because if it's the only game in town, your only other option you either play regardless of whether it's bubbly or not, or you sit on the sidelines. Um,
Yeah.
and neither of those are nearly as appealing as they maybe could be. And like 91% of fund managers saying US stocks are overvalued, well, they're still invested.
Yeah.
Um,
Right. Yeah, I mean, similar to how you'd say it takes one great stock to make for a great portfolio, it takes one great sector to
yeah.
lift all boats, and that's what's been happening the last couple of years, and we'll see how long it goes. You mentioned um, that being sort of the only AI being sort of the only game in town now. There is one other sector that is having a very good month, not a sector that you would expect. Cannabis, as we mentioned, um, which has been, in the dumps for years. Suddenly, this month it is up. Cannabis stocks are up more than 60%, roughly 60%, and actually are now up for the year, up more than 20% for the year, just literally because of they're underwater until, the start of this month. What's behind the rally? Well, our Michael Brush, who runs, fortunately, we have a cannabis expert at Cabot, who runs Cabot Cannabis Investor, wrote about it this week. It's that the Trump administration is giving signals, although nothing concrete, that they are going to push for the long telegraphed um, shift from cannabis from a Schedule One drug, which is in this class of all the worst drugs you can imagine, cocaine, LSD, heroin, everything, to Schedule Three, which would be great for the industry. Um, Now, there's nothing. Who knows if this will happen? We've seen fits and starts like this where it's been under Biden. This was, there was a thought that this was going to happen late last year before he exited office, and it never did. As Michael points out, the public push. This is one issue that, Democrats and Republicans agree on. I think like roughly two-thirds or more than 60% of Americans want to legalize cannabis, and their support for rescheduling. We'll see how this is 3 weeks, or no, sorry, 2 weeks of a huge run up, but this is a little bit like I think we've called this sort of like the boy cried wolf. I gotta believe it. I gotta see rescheduling happen um, before I really believe it will. This might be one of the rare. Usually, you buy the rumor, sell the news kind of a thing. This might not really take off until we see the actual news.
Yeah, like I mean, exactly to your point. So in 2023, between August 25th and September 15th, MSOS, which is a marijuana tracking ETF, was up 85% on rumors of rescheduling. It went from 490 a share to like what $8 a share. Or I'm sorry, yeah, it went up to over $8 a share. It was up 85% in that roughly 3 week span. And in the last month, it's up 83.4%. Right.
Yeah.
Like this, not only is this something that we've seen under all kinds of different administrations, we've seen like the exact same performance in the
Yes.
almost exactly the same time of year under
Yeah.
two administrations, like to the percentage. This
I
is,
think it's this time of year every year. It seems.
yeah, I mean, what's the only catalyst is rescheduling.
Yeah. Or
That's
the Farm Bill, which seems less likely to happen anytime soon. Um, that's
what
what is that one? I know
the
that.
farm bill was CBD and stuff like that, and all these
Oh, sorry,
derivative
sorry. That's the past one. There's another one.
safe banking is the one you're
Safe
thinking of.
banking. Sorry. Yeah, yeah. Yeah, you're right. Farm Bill was years ago.
Yeah.
Yeah, safe banking, which that I don't think that's been talked about as much. That was something that Michael was optimistic about could potentially also happen in addition to rescheduling about a year or two ago. And that just sort of gets, they kick the can down the road, and here it is.
I mean, to your earlier point about like if this is, if you had avoided AI, your portfolio would have suffered, or if you hadn't invested because you're too concerned that AI might be a bubble. The cannabis one, I think I'm okay being on the sidelines for
Yes.
it.
Yeah. I've
Um,
been duped before. The 2023 run duped me, and I lost money real quick
at the
in
same,
whatever I bought.
I mean, at the same time, it is as cheap as it's ever been.
Yeah.
Performance looks good. I guess, I mean, the problem is you're just waiting on your catalyst is whatever the president wants to do. And
Right.
I fancy myself a bit of a like a big picture thinker, but I have no idea what is coming from the White House on any given day. So I think that is ultimately the deciding factor for me.
Yeah.
If you're bought in on the president's commitment, the promises made, promises kept, if you are if you're behind, him sticking to that, then by all means, I am not. I think that there's too much. He's a little bit too mercurial and sort of willing to say things that say whatever is with the winds of change, and then sort of make the final decision at a later point. So I'm out, but
Yeah. I think if your timetable is like 10 years, if you're willing to play the long game on cannabis, I think you'll profit. I think you'll do probably pretty well. Um, if your timetable is a year to, let's say, 3.5 years, then uh, who knows? All bets are off. Just to put in perspective, cannabis stocks topped in February 2021. So this is the Amplify Alternative Harvest ETF, MJ, which is sort of the benchmark index. Is it right around 300? It's now at 32 a share, even after the big run up in the last month. I mean, it's definitely low if you want to buy low. Again, if you're investing for 10 years, not wouldn't be a bad idea to buy here, but you might have to really wait a long time and go through a lot of volatility. You got to have a strong stomach for it.
yeah, I do think, right, like if you're buying for the 10-year time horizon, don't buy the leveraged ones,
Yeah,
because that time decay will just eat you alive. You'll
yeah,
keep waiting and it'll keep bleeding down and getting reverse split and bleeding down and getting reverse split. I think you go one of two directions. You either buy an ETF
mhm,
with the assumption that there will be sector consolidation, right? Like these companies, because of the current tax laws, they aren't turning profits. They can't write off expenses. The big ones are going to swallow up some of the smaller ones. The ETF gives you the benefit of like, well, if the small one is going out of business and a big one eats it up, you still own the big one.
yeah,
Or you really pick your spots and you target companies that you really like. There are any number of these marijuana companies that go out of business or are going out of business on, I don't want to say a regular basis, but it's certainly something that we've seen happening. Um, and picking winners and losers is or can be a challenge. I think if you like the sector, you buy the ETF rather
yeah.
than try and
MSOS, not MSOX, which is the
yeah,
latest. I know Michael uses that very effectively when he thinks. Yeah, I think he really hammers MSOX when the stocks fall to a certain extreme, which they have
yeah,
often. Usually, I think he said end of July is like look for a turnaround here soon, and you probably didn't expect it to be quite like this,
right.
but this isn't anything new from the last couple of years. We have seen big spikes like this. We're 2 weeks into it. If we get 2 months into it, then you may have something. Um, then that might actually be a signal that something could happen, but I still feel like until it happens, rescheduling,
Yeah,
safe banking, whatever, I'm going to
it's
be skeptical.
yeah, the president has a long track record of floating trial balloons where it's like, hey, all right, I'm going to float this concept as a means of testing public opinion on it, and then I'm gonna make my decision sort of based on that. So if
Yep.
he's saying, we're going to seriously look at reschedule. I mean, the other thing is, I believe he floated the possibility of rescheduling at like a fundraiser dinner or a working group meeting for the cannabis sector, right? So it's in an environment in which the most important people in the room, aside from him, are all pro cannabis.
Yeah.
So there is also an element of, is
Playing
he
to the
just
crowd.
he's playing to, yeah, I think playing to the crowd, I think is the favorable interpretation of this sort of when he floats these sort of concepts or when he talks about these things. It's like I mean, most people are probably not going to hold, you can't hold him to every word he says. That would be unfair. At the same time, he is more inclined to play to the crowd than I think a lot of politicians out there. So don't read too much into it if he's just playing to the crowd.
Yeah. Yeah, like I said, if a month or two from now they're still elevated, there hasn't been a big pullback, um, then it might be worth, really exploring, okay, what's going on here? Maybe there's something to this. Okay,
Yeah.
before we go today, just wanted to mention our offer for today. It's we're offering, this is rare. We're offering Cabot Options Trader, which by Jacob Mintz, who's a frequent guest here, normally closed to the public. But for this weekend, through this weekend, or I think really until it reaches full capacity, so it could be quicker than that, we're opening it up and offering for listeners to today's podcast $500 off the normal price if you go to cabotwealth.com/street. That's Cabot Options Trader, run by Jacob Mintz, who's as good an options trader there is out there, is running that service for more than a decade. It's a weekly advisory. You get every Monday, you get updates from Jacob on all things options market, all things affecting the options market and all of his positions, his trades. You get frequent trade alerts, basically daily options education. He'll walk you through every single trade and his rationale and everything. And you get three special reports: how to choose an expiration and strike, options terminology, buy rights versus naked puts. And you get email access to Jacob. Again, that's cabotwealth.com/street. And if you go to that now, quickly, you can claim a spot for $500 off the normal price. I think that's a podcast. What do you think?
Yeah,
Yeah.
yeah, I would agree. I don't no pushback there. I'll deviate from my norm and not push back on the things other people say.
Okay. Okay. Well, thanks for joining us. And we will see you again next week with another Street Check.